today's Introduction to Investing workshop. We are extremely excited to teach you about an important life skill that will hopefully lead you to a path of financial independence. If you don't know me, I'm Sonny. I'm a fifth-year mechanical engineer, and I'm the current president of SASE. I've been investing since 2017, and I am actively learning more about how to set myself for financial success. Hosting with me today is my friend Tou Kan, who will introduce himself.
All right. Hi, everyone. For those of you who don't know me, I just graduated Northeastern in December as a finance and accounting major, but I'm coming back to Northeastern later this year for grad school. My background is mainly in accounting, and I will be working in financial audit in New York after I finish grad school. I have been involved with SASE events occasionally in the past, but those of you who are old enough to remember me probably remember me as the previous treasurer for ASU. I also want to start this presentation by saying that this is meant to be informative and educational, so feel free to stop or interrupt us if something is not clear or you want clarification. We're not being graded on this, so I do want this to be a good use of everyone's time, so feel free to ask questions throughout the presentation.
Yeah, and you can just type it in the chat too if you want it, and we'll check it here and there and try to respond when we can. Yeah, and a little interesting fact between me and Tou. So 2 years ago, we were at a SASE Pals event at Kung Fu Tea, per usual, and I struck up a conversation with Tou and his friends, right? And he actually mentioned, he's into stocks, he's a accounting major. So I was like, oh, dude, Roth IRAs, I need to get one. Can you talk about it? And then we talked about it for the next hour. So as you can see, both of us, we are very passionate about the topic, and we are both very excited to talk to you today about the power of investing. And before we start, just a disclaimer, we are not responsible for any of your financial decisions. And this presentation shown today is based on our own research and experiences. So we encourage you to conduct further research after this to supplement this information. And without further ado, let's begin. Next slide.
Yeah, I don't know why it's not working. Hold on. Okay. Okay.
Nice. All right. So let's start off with what is investing? So investing is essentially expending money with the expectation of making more money. This can come in many forms, such as real estate, the stock market, collecting and trading collectibles, right? Each come with their own pros and cons, and some methods are more reliable than others. A financially savvy person is expected to have multiple forms of investments to diversify their income, and most often it's probably going to be a combination of stocks, bonds, and real estate. That's for way later. But for this presentation, we'll be focusing mainly on stocks, mutual funds, and bonds. Next. Great. So now, I'm sure all of you have heard that investing is important, but why is that? Isn't it kind of like gambling your money away? Why not put it in a savings account and be safe? So here's a number that you need to know, and that's 1.7, and you can see it over there. This is the rate of inflation for 2021. Inflation rate changes all the time based on many factors, and it's actually lower this year compared to the 2.16 average from 1997 to 2018. So what does this mean for you? This means that the value of your dollar is actually 1.7% less each year. So imagine your favorite bakery sells egg tarts for $1, right? Your parents give you $1 allowance every week, so you can buy one after school, so you can treat yourself. Next year, the bakery sells them at $1.02 to keep up with inflation. But too bad, your dollar is only worth $1, so you can't buy this egg tart. So you'll either need to wait for the next allowance or find some spare change to buy your egg tarts now. You feel sad, you feel cheated, and you look into ways to invest your money so that this never happens again. But it's going to happen anyways, but you're going to be more prepared in the future. So though this is a trivial example, inflation actually affects everything. It affects the cost of everything, your everyday food, gas, you name it. And by investing, you won't be left out losing. Next slide. Great. So a lot of you may be putting the majority of your money in either a checking or savings account. How does this compare to investing? Let's start off with a checking account. It's basically the same as putting your money under the mattress because you're not really doing anything with the money. It may be safe, but it's losing its purchasing power every year, even though the number itself stays the same. So say you have like $1,000 in your checking account, you're still gonna get it. It's still gonna say $1,000 like forever, but you won't be able to buy the same thing like today as like 20 years down the line because of the purchasing power. For a savings account, you may earn at most 0.6% of your money every year, and that's being very generous. It's usually a little bit lower. But sure, you're making like that 6%, sorry, 0.6%. You're also netting a loss of 1.1%. So you're not losing as much like purchasing power, but you still are losing. If you were to invest, you can potentially make more than the 1.7% of your investment and overcome that inflation. On average, you can expect to have an annual return of 8% of your investment every year, not including inflation, if you were to put your money into the S&P 500 index, which tracks the top 500 companies in the US. Of course, there's a time and place for a savings account that's typically for short-term goals and emergencies. Investing is for long-term goals, such as trying to make money to buy a house, get a car, or simply retirement. So the main takeaway here is you'll keep losing money unless you invest. And that sounds terrible. It's just how it is, but how to get over that is to start now. Next.
All right, so if there's only one thing that you guys will take away from today's presentation, I want this to be the one thing. I want this one thing to be the concept of the time value of money. So let's start with a relatively basic example, right? So let's say today you decide you're going to save some money. You're not going to buy your $5 daily boba, and you're going to invest the $5. And so let's take a look at the chart here on the right. Can you guys see my spotlight thing?
Yep.
Does it work? Okay. So, so let's say you save your $5 today, right? And so in the very first year, let's say you earn 10% interest. You will earn 50 cents in interest during your first year, and you will end the first year with $5.50. Big deal. You earn 50 cents. But let's take a look at what happens in year two. So in year two, you start with $5.50, and instead of earning 50 cents, you earn 55 cents, and you end with $6.05. So the idea here is because you're earning interest on the interest you already earned in year one, every year, the amount of interest you earn increases, right? In year three, it goes up to 61 cents, year four, 7 cents, et cetera, et cetera, et cetera. So you actually see that after 20 years, you will end up with $33.64. So basically, if you save $5 today and you invest that $5 with a 10% return, after 20 years, you will end up with $33.64. It may seem like $33.64 still isn't really a lot of money, but the same concept applies when you invest a smaller amount or a larger amount. So let's say instead of spending $55,000 on a brand new BMW, let's say you buy a used Toyota for $5,000 and then you invest the remaining $50,000. It's the same concept whether you invest $5,000 or $50,000. After 20 years, assuming you make 10% returns, you will end up with $336,000. So that's no longer such a small amount of money there. The same concept applies, like I said, whether you're investing $1, $2, $10, $1 million. After 20 years, you could have potentially multiplied your money by a factor of 6 or 7 times. So let's take a look at another pretty basic example. Let's say you manage to save $1 every day. And then at the end of each year, you invest the $365 that you save. So if you simply save $1 a day and you just stuffed it in your mattress, after 20 years, you would have had $7,300 in your mattress. But if you invested that money at the end of each year with 10% returns, instead of having $7,000, you would have had $23,000. So that's the difference between just saving your money and investing your money. And of course, these examples that we're going to use take into account the fact that you're going to earn 10% returns. That's perhaps realistic, perhaps unrealistic. We'll get into that a little bit later. But the illustration still stands regardless of the interest rate or the rate of return that you are earning. So this this chart here basically illustrates the same thing. So let's say I start off with $1,000. If I put that $1,000 in the piggy bank, after 20 years, I'll still only have $1,000. That is the green portion of the chart right here. All right, so let's take a look at the blue piece. If you don't take advantage of this compound interest, if you put $1,000 in some investment that earns 10%, the very first year you will earn $100. If you take that $100 out, you do something else with $100, you spend it or you burn it or whatever you do with it, and you're only left with the $1,000 that you initially put in, the second year you will also only earn $100. So without compounding interest, and every year you only earn $100, after 20 years, you will have had $3,000. That's this blue line over here. But let's take a look at what happens when I allow this earning to compound. So the very first year, I have $1,000, right? $1,000 right here, and I earn 10%. So I earn $100 in interest. The second year, I earn interest on my initial investment plus my interest. So I start off with $1,100 and I earn 10% interest, so I earn $110 in interest. In the third year, I earn $121 in interest. So every year, I earn interest on my interest, and the amount of money that I have increases exponentially. So the purple portion here shows that after 20 years, with compounding interest, you would have had $7,000. So even with regular simple interest, you would have only had $3,000. It's the compound interest that gets you from 3 to 7 after a 20-year time span. Now, I don't know how many of you have learned about the rule of 72. I think I learned about this in one of my high school math classes, but I found this to be a very easy way to visualize compound interest. Basically, the rule of 72 states that the time that it will take for your money to double is approximately 72 divided by the interest rate. So if you have an interest rate of 10%, it will take approximately 7.2 years for your money to double. It's not exact, but it's a good approximation. So basically, if you're earning 10%, your money will double after 7 years, and then it will double again after another 7 years. So you would have essentially quadrupled your money after 14 or so years. Does everything make sense so far? Does this compound interest concept make sense? If anyone has any questions, you can ask. Okay, so let's move on since no one has questions. Okay, let's take a look at why exactly it is important to invest for retirement. So most retirees end up relying on something called Social Security, which is basically a check that they receive from the government every month after they retire. So while you work, if you guys have worked co-ops or summer jobs or part-time jobs or whatever, if you look at your paycheck and you look at the deductions, you will see a deduction for FICA or FICA. That stands for Federal Insurance Contributions Act. That's basically the same thing as Social Security. It's better known as Social Security. And the basic idea behind Social Security is that while you work, you contribute a certain amount of money into this big pool of money that's managed by the federal government. And then when you retire, you start receiving money from the pool of money. There's a couple of issues, if you will, with this model. For example, when Social Security was created, it was normal for people to retire at the age of 65 and pass away by the age of 70, because Social Security was created in the 1930s, and that's just how long people lived back in the 1930s. It was not expected that people would live until 80 or 90 or 95 after retiring at 65. So nowadays, people are also having fewer kids. It used to be that people had 3, 5, 6 kids. So when they retire, there's a lot more people contributing into the pool while they take the money out. This is kind of no longer the case in this country. So about 2 or 3 years ago, Social Security started having more money taken out of it than being put in, which is problematic because eventually you run out of money. And without changing the way it is now, it's actually estimated to go bankrupt somewhere between 2034 and 2037. Now, I highly, highly doubt that will actually happen because they will find funding from somewhere else. But I think it's important for us, regardless, to not expect to receive too much from Social Security because chances are there's not going to be a whole lot of money left in Social Security when it comes time for us to retire. Another thing is that there used to be a time when pensions were common, and pensions are basically a paycheck that you continue to receive from your previous employer after you leave, after you retire, until you pass away. It's a similar problem with pensions is that when people live longer than expected, pensions become very, very expensive for employers. This was a big reason that GM and Chrysler went bankrupt in 2008 because they had all these pension obligations to people who were living longer than expected. So nowadays, pensions have become very rare. Unless you work for the government and you are a teacher or you're a postal worker, chances are you're not going to receive a pension. So the reason that I bring all this up is that the uncertainty surrounding Social Security, the lack of pensions basically means it's really important for us to save for our own retirement. The average Social Security check is today $1,500 a month. We don't know, that may go down, right? So it's less than $20,000 a year. It's not a whole lot of money. So it's really important for us to save for our own retirement. But fortunately, besides normal savings, there are two additional accounts or two additional ways that the government and employers have set up to assist us with saving for retirement. The first is something called an employer-sponsored plan. You will normally see this called a 401k. There's also something called the 403b. It's mainly for government employees. It's pretty much the same thing as 401k. You don't have to worry about the differences between 401k and 403b. They're both types of employee-sponsored plans. So the contributions you make into an employee-sponsored plan come directly from your paycheck. You tell your employer how much to withhold from your paycheck that goes into the employer-sponsored plan. The second is something called an individual retirement account. As you can probably guess from the name, the main difference between the IRA or the individual retirement account and the 401k is that the IRA is managed by you. Okay, the 401k is managed by your employer, the IRA is managed by you. Both the employer-sponsored plans and the individual retirement account. So both these types of plans come in Roth and traditional varieties, and I will get into that right now. So let's say you want to buy a stock. You want to open a stock. You don't care about retirement. You just want to buy a stock. How you buy a stock is you open a stock brokerage account. So this is just called a normal brokerage account. There's no restrictions to a brokerage account. You can open the account, put money in, invest in whatever you want, take money out as you please. But the brokerage account has no tax benefits. It's just a normal stock trading account. So as an example, right? Let's say I work a summer job. I earn $1,000. Okay, I can actually annotate here. So I actually wrote it down. So I earn $1,000 and I want to invest into this normal brokerage account. When I earn money, I have to pay income tax, right? So I pay 20% income tax to the government. So I lose $200 of my money and I only have $800 remaining. And I invest this entire $800. And let's say I buy Tesla stock with this $800. And I earn 10% return, the stock goes up 10%, and then I sell the stock at a 10% higher price than what I paid for it. So I earned 80 bucks. Now, when I earn money on stock, that's called a capital gain, and I have to pay income tax on that. So the government is going to want $16 of this $80 that I earn, which means at the end of the day, I'm only left with $864. Now, if I put money into a tax advantaged account, let's say the Roth account, this is what happens. I earn $1,000, I pay my income tax, just like I did with the brokerage account. So I invest the entire $800 into Tesla stock. Tesla stock goes up 10%. I earn 80 bucks. Now, I pay zero taxes on this $80 that I earn because the government basically set this up as an incentive for you to save for your retirement. So they want you to save, they want you to invest. And so when you invest in a Roth account, whether this is an employer-sponsored Roth account, so whether this is a Roth 401k or a Roth IRA, you pay zero taxes. Is there a difference? Oh, so Sarah has a question. Is there a difference between how long-term and short-term capital gains are taxed? And is that dependent on how much you gain? So yes, there is a difference. Sonny will get into that a little bit later, but long story short, if you hold a stock for longer than 1 year, it's treated as long-term gain. If you sell it within 1 year of purchasing it, it's short-term gain. Short-term gain counts as normal income. So it's taxed at your normal income rate. If you hold it for longer than 1 year, it's a long-term gain, you get taxed at a lower rate. Sonny will show you the rates later, but it's a significantly lower rate. So it usually is very, very, very beneficial for you to hold the stock for longer than 1 year. But I do want to point out that the long-term, short-term capital gain tax is only important for the brokerage account here, because all the money that you earn inside a Roth account never gets taxed again. The money you put into a Roth account is post-tax money. You already paid tax on the money that you put into a Roth account when you earned it. Once you put it in there, anything you make in a Roth account is never taxed again. Okay, hopefully that makes sense. Is income from stocks also subjected to state and city tax? Ooh, that's a good question. So I know for a fact that it is subject to state tax. I'm not sure about city tax. If you, for example, if you live in New York City, if you live in the 5 boroughs of New York City, you have to pay a city tax as well. I don't live in the 5 boroughs, so I'm not 100% sure, but I do believe you do have to pay it. I think it depends on the municipality. But generally the way they look at it is income, and you need to pay it. You need to pay state, city, federal taxes. If that answers your question. Okay, so and yeah, keep throwing questions in the chat if you have questions. I'm happy to answer as we go. So that's the Roth account basically. The Roth account is it's pretty clear here. The money you make in a Roth account, you don't ever have to pay taxes on it again. Now, a traditional account is slightly different. A traditional account, and again, the traditional account comes in 401k varieties and IRA varieties. So when you have a 401k or an individual retirement account, you can choose a Roth or traditional. But okay, so let's say I work my summer job, I earn my $1,000. That $1,000 is technically supposed to be taxed. But if I put it into a traditional retirement account, that money, that tax is deferred. So I don't pay taxes on that money yet. I pay taxes on that money when I pull the money out. So basically the government says, okay, we're not going to tax you now. So you get the whole $1,000 in your account that you can invest. So let's say I invest in the same thing. Let's say I invest in Tesla. Okay, so I have $1,000 to invest instead of $800 to invest. And I earn 10% return. Tesla goes up 10%. I sell Tesla at a 10% higher price. I earned $100. So now I have $1,100 in my account, in my traditional account. Now, if I actually want to use this money, I have to take the money out of the account. when I take the money out of the account, that gets considered income. So if I take out the entire balance of my account, then I have to pay this income tax rate, assuming my income tax rate stays the same at 20%. I have to pay $220 on the $1,100 that's in my account. And at the end of the day, I'm left with $880. So you can see from these two examples that if your income tax rate stays the same at 20% and 20%, it makes no difference whether you put the money in a Roth or a traditional, because you're left with $880 regardless. Okay. The point here that I wanted to make is that if you know you're going to save the money anyway, and you know you're going to invest the money, it is much more advantageous to put it in either the Roth or the traditional account than it is the normal brokerage account. As much money as you know you're not going to need it, and you know you're going to save it, it's very beneficial to put it in the Roth or the traditional because you don't get taxed twice. Now, whether you want to put into Roth or traditional is very dependent on what you expect your tax rate to be. So like I put over here, the normal brokerage account is subject to, if you want to call it double taxation. You get taxed on the money you put in and the money you earn. On the Roth account, you get taxed upfront. So you get taxed today before you put the money in. On the traditional account, you get taxed at withdrawal. Generally, for us, that will mean that gets taxed when we are 70 or 75 or whenever you decide to take the money out. So the question is, do you want to pay taxes on your tax rate today or pay taxes on your tax rate then? We don't know what our tax rate is going to be like when we're 75. We don't know what tax rates are going to be in general. We don't know what our income is going to be like when we're 75. For you guys, and like this is what I do, because I assume most of you guys probably aren't making a ton of money right now because we're probably working part-time, co-ops, etc. So our tax rate is relatively low right now. So I put all my money into a Roth account because I'd rather pay my low tax rate now than whatever tax rate I'm going to have to pay in the future, which I assume will be higher than my tax rate today. When we make more money, say we're middle-aged and we're at the height of our careers and we're making more money and we're paying higher taxes, it probably makes sense for us to put money in a traditional account because chances are when we retire, our income will be lower than it is when we are at the peak of our careers. So whether you want to put money into Roth and traditional is kind of up to you. I know people who think that, oh, tax rates are going to rise. So even if they're at the height of their careers now, they still want to put money in a Roth. That's up for you to decide. But that's the idea behind a Roth and traditional. You either get taxed now or you get taxed later. Okay, so let's move on. Oh, so how much can you contribute into these accounts? It changes every year. Generally, every few years, it goes up by $500 or $1,000 or something. So for 2021, if you're under the age of 50, you can contribute up to $19,500 into a 401k and $6,000 into an IRA. These are independent. So you can contribute $19,500 in the 401k plus $6,000 in the IRA if you want to max out everything. But keep in mind the contribution limits apply to contributions made towards both the Roth and the traditional accounts. So you cannot put $6,000 in a Roth IRA and then $6,000 in traditional IRA. If you want to split it up 3 and 3, you can. If you want to do 6 and 0, that's fine, but you can't do 6 and 6. And the same applies to the 401k. You can't put $19,500 in a Roth 401k and then $19,500 in the traditional 401k. It's one or the other. This is, I guess, irrelevant for you guys, but if you're over the age of 50, they'd let you put more money in. So you can put $25,000 a year if you're over the age of 50. The idea being because you're closer to retirement age, they want you to be able to save more money if you choose to do so. There's one thing to consider with putting money into these accounts. Because of the advantageous tax treatment that they offer, you're not allowed to just put money in and take money out as you please, because otherwise everyone would max it out if they could. Early withdrawal of money in these retirement accounts results in a penalty. However, there are certain exceptions. For example, I believe when you purchase your first home, if you are under a certain income and your home is a certain value or something like that, you get to take money out without penalty. Another example is last year, because of COVID-19 and people were having financial hardships, the government allowed people to withdraw their own money out of their retirement accounts without penalty. But generally speaking, if you put money into these tax advantage retirement accounts, you should not expect to take the money out until you retire. Another important thing to note is that no catch-up payments are allowed. Okay, if you don't contribute your $6,000 into your 2021 IRA, you can't decide in 2022 that I'm going to put $12,000 in. It doesn't work like that. You can put $6,000 in this year, $6,000 in next year. You can't make it up if you didn't do it this year. So if you want to max it out, you have to max it out this year. You do have until, I want to say, April sometime of the following year to make your contributions for the previous year. So for example, if you guys wanted to make contributions for 2020, you can still make contributions for 2020 up until, I think it's like April 15th. Don't quote me on that. You should probably double check that if you're actually going to do it. Another thing is that when you start working full time and your employer offers this 401k plan, this employer-sponsored plan, most of the time, there will be something called an employer match. The employer match basically is the employer saying that if you put, say, $10,000 into your 401k, the employer will also put $10,000 into your 401k. Right? It sounds great because it is great. It's essentially a 100% immediate return on your money. You're not going to get this anywhere else. Usually, the employer won't match the entire federal limit, so most employers won't match $19,500. Some will do $5,000, some will do $10,000. Like I said, when you're putting money into the 401k, you don't expect to take the money out. So there's many reasons people won't max it out, right? If you have student loans you want to pay off, if you're saving money to buy a house, or whatever reason, you don't want to put the full $19,500 into your 401k. That's fine, right? But you should always take advantage of the employer match. If it's $5,000, put in the $5,000, at least $5,000. If it's $10,000, put in at least $10,000 because it's free money. If you put in $10,000, the employer will put in $10,000. You don't want to lose that. It's better than any return you will make from the stock. Okay, so now that you have money in your accounts, right, whether it's a brokerage account, 401k, IRA, whatever account you have to decide what to do with the money. So the most important or most rather popular stock investment is stocks. So the basic idea behind stocks is that you own a piece of the company that you're investing in. So let's take Apple, for example. Apple has 20 billion shares. It's actually something like, it's like a little bit less than 20. It's like 19 point something, whatever. But for simplicity's sake, I'm just going to say it's 20 billion shares. If you own one share of Apple, you basically own 1/20 billionth of the company. Okay, so you own this tiny piece of the company. Another thing that's basically a stock is called an ETF. That stands for Exchange Traded Fund or a mutual fund. They're more or less the same thing. ETFs and mutual funds are more or less the same thing. They differ on the way that they are traded. They're different ways of selling and buying them, but they are, for the purposes of this presentation, they are the same thing. You don't have to worry about the differences. But the idea behind an ETF is that, let's say you want to buy a bunch of different stocks. Let's say you want to buy 500 different companies. Instead of you literally physically buying 500 different individual stocks and keeping track of 5 different stocks in your portfolio, you can buy this one fund that holds the 500 different stocks. So the most popular metric is something called the S&P 500. The S&P 500 is the United States, the USA's 500 largest companies. So that includes companies like Disney, it includes Apple, it includes General Motors and Johnson & Johnson, et cetera, et cetera. So it includes all these huge companies. When people talk about the market, they say, oh, the market goes up or the market's down today. When people refer to, oh, the market's inflated, the market's overpriced. When people talk about the market, almost always they are talking about the S&P 500. So they're talking about this collective 500 companies within the United States stock market, right, if that makes sense. So the great thing about ETFs and mutual funds is that you don't have to buy these 500 individual stocks. You can buy a fund that's managed by various different asset managers. So Fidelity has one, Charles Schwab has one, Vanguard has one. All these companies have S&P 500 funds, and they're more or less the same thing because they all buy the same thing. They all buy these 500 companies. Now, obviously, they don't do this for free. There's a small fee associated with it. But the one that I buy is from iShares, and the fee is very small. I want to say it's 0.03%. So it's really not worth your while at all to try to buy these 500 stocks yourself. Now, if you want a different weight, right? If you want more of one company, you can buy one company. But if you should never try to recreate the S&P 500 on your own. Now, besides the S&P 500, there's also sector-specific stocks, rather sector-specific ETFs. So let's say you want to buy energy stocks, but you don't know if you want to buy ExxonMobil or Chevron or Shell or BP. You can buy an energy ETF. So this energy ETF or this energy fund will have maybe 100 or 200 different energy companies in it. And it'll be managed by a company like Fidelity. And you just buy a piece of the fund which holds all these different things. So you don't have to, if you don't want to research, oh, which specific company is best or which one you think is going to outperform, or if you just want to invest in a specific sector, you can invest in a sector-specific ETF or mutual fund. So that's the basic idea behind stocks, is that you're owning a piece of the company. A bond is a little bit different. A bond is basically a loan. If you have a, let's say an Apple bond, an Apple 10-year bond, that means you lent money to Apple for 10 years. Every year, Apple will pay you an interest payment, right? So maybe that's 3%, maybe that's 5%. But if you lend money to Apple, every year they give you a 3, 5%, or 6%, or whatever the interest rate is on that bond payment. And then at the end of 10 years, you get your initial investment back. So a bond is basically a loan. Bonds are generally considered safer than stocks for many reasons. One is that you know what your payment is going to be. You know that Apple is going to give you your 3% this year. And the other thing is that when a company goes bankrupt, you hold a bond, you are a lender to the company. Lenders always get paid first before the stockholders. So if a company goes bankrupt, if you're a bondholder, chances are you'll get your money back. If you're a stockholder, you probably won't because you own the company. So bonds generally have much, I don't want to say much, but they have lower yields and lower rates of return than stocks. As an example, Apple stock went up 100% last year. It actually was more than 100%. It was like 120%. You're not going to find any bonds that pay 120%. Bonds pay usually somewhere between 5 and 20%. Stocks, you don't know. But with stocks, stocks can go down in value. Bonds usually won't go down in value unless the company goes bankrupt. So the different types of bonds, you have corporate bonds, right? That's money you loan to companies like Apple, like Tesla, like Johnson & Johnson. You have treasury bonds, which is money you loan to the federal government. So, for example, if the federal government wants to, they want to put out, stimulus checks, they have to get this money from somewhere. So, they issue treasury bonds. Investors lend the money to the federal government, and the federal government will pay them back interest. And then after the bond expires, the federal government will return the initial investment amount to the investor. The same concept applies to municipal bonds. So municipal bonds are bonds that are issued by cities, like San Francisco issues municipal bonds, for example. So those are the three main types of bonds. There's other bonds as well, but most of the bonds that you will invest in will be in these three categories. There's also commodities. So a commodity is literally an item, like gold and silver. So you can invest in gold by literally buying a gold bar and keeping it in your house somewhere if you choose to do so. Or there's funds that hold this gold in a vault, and you can buy a piece of the vault. I actually have a small amount of money in a gold trust. So there's gold bars that are in this vault somewhere. I actually don't know where the vault is. But I own a tiny piece of this vault. So that way I don't actually have the physical gold in my possession. But the idea behind the commodity is, the price goes up, you can sell it, you can make money. When the price goes down, you lose money. But the aim is to make money. So hopefully the price goes up. So cryptocurrency is the new hot item, as you guys all know. It's more or less the same idea as a commodity, but it's not really a physical item the way gold is, and it's much more speculative, and it's hard to assign a real value to. So a commodity, for example, like silver. Silver is used in manufacturing. It's used in building things. There's a real value assigned to silver. One can make the argument that there's no real value assigned to cryptocurrencies. But it's the same concept that you're buying this item, this thing, and that you want it to go up in value. But cryptocurrencies are much more speculative, much more volatile than commodities. Does anyone have any questions here about the different types of investments? I need a drink of water, so let's see. Are there extra management fees for ETFs or mutual funds put together by a company? So yes, so most so one of the important things when you're looking at different funds is that you want to select a low fee fund. I've seen funds that go up to like 1% fees. 1% is a really big fee, right? If you think about what that means, is that if I earn, let's say, 5% return on this fund, whoever's managing the fund will take 1% of that. So I'm only left with 4%. So that's a huge fee. So the ETFs and mutual funds will always publish their fees. Different asset managers will have more or less the same funds, but sometimes one will charge a much higher fee than the other. So you do have to do your research on this. Most of the Fidelity funds that I invest in have fees between 0.03% and 0.08%. It's generally pretty small. Usually the more money that's under management, so the larger the fund itself is, the smaller the fee, because the fee is being spread out to more people. But you do have to look at that. Now, if the fee is small enough, right, if you think about 0.03%, that means for every, what is it? For every $10,000, I'm paying $3 a year. So it's really not, it's not a big fee if for low cost funds. But yes, there are management fees. No one's going to do it. How would these investments allow us to have compounding interest? Good question. So the idea behind so let me put it this way. Any investment you make in a stock, right? Whether it's a single stock, whether you buy a single share of Apple, or you buy a piece of an ETF that has 500 different stocks. Whether you, it doesn't matter what you buy, right? It's not a fixed, it's not like, oh, it's going to go up 5% every year, every single year. Some years it's going to go up 30%. Some years it's going to go down 20%. On average, you make 5% or 10%. But the idea behind it is that the idea behind compounding interest is that the longer you put your money into it, you allow the interest that you earn to make more money. So, for example, if I buy a share of Apple at $100, or I buy an ETF at $100 that has 500 different tech companies. Let's say in the first year, the investment goes up 10%, right? So that the value is now $110. The following year, whatever amount it goes up or goes down, for this argument, let's just say it goes up, right? But for any amount that it goes up, the percentage is based on your what you had at the beginning of the year. So what you had at the beginning of the year is now 110 instead of 100. So if it goes up another 10%, then it went up $11 because you allowed the money that you allowed the growth to grow again, if that makes sense. Feel free to put up a follow-up question if that explanation doesn't make sense. So Sarah has a follow-up question. The fee is on how much you invest or the gain? Oh, that's a very good question. So the fee is based on how much you invest. The fee, whenever you see 0.03% or 0.08% fee, that is always, that's a fee on assets under management. So that's a fee on the total amount of money. That's an annual fee. You won't see it, okay? It's not like they send you a bill for this fee and you have to pay it. What happens is they just take the money out of the net assets of the fund. So if you don't pay attention to the fee, you'll never notice it because it's not like it's going to show up on any sort of statement. They just pull the money out and it reduces the total returns. So what are some benefits investing in a sector-specific fund over an S&P fund? Oh, good question. So if you, so for example, S&P fund has all sorts of sectors, but if you think a specific sector is going to do, is going to be great. So for example, let's say at the beginning of the pandemic, you had the foresight to think that, oh, wow, technology stocks are going to boom because pandemic and technology and whatever. So you don't want to just invest in an S&P fund because the S&P fund has a whole bunch of other companies like, that weren't doing so hot, like General Electric. Like if you think that tech companies like Tesla and Amazon are going to boom, then you don't care about General Electric. You don't want to invest in those companies. So you may want to specifically invest in only tech companies. So then maybe instead of choosing 3 or 4 tech companies, you may want to invest in an entire tech fund. So the benefits have to do with, has to do with less diversification, which usually means higher risk, but also the potential for higher returns. As an example, bank stocks, for example, tanked at the very beginning of the pandemic, more than some other companies, right? Like more than the S&P 500 in total. So if you had put $10,000 or whatever amount of money you wanted to put into a financials fund that only invested in banks, credit unions, and those type of companies, you would have made higher returns than if you had just put it in the S&P, if that makes sense. So it's like if energy was the same thing, right? Because energy prices, like oil prices, went down so much at the very beginning of the pandemic. If you had the belief that oil is going to go back up, you would want to put more money into an oil fund or an energy fund than the S&P broad market.
Yeah, I can kind of talk about this one too, if you don't mind.
Sure. Yeah, go ahead.
So the S&P is like the top like 500 companies, right? It's not specific to any like industry, so that can include like aviation, defense, entertainment business such as Disney. A bunch of these companies like suffered throughout the pandemic, right? But there's other companies that definitely thrived, such as Procter and Gamble, Johnson and Johnson. These are like the consumer products, like people started investing more money into beauty, healthcare, like these personal beauty products that basically anything else that's like household related. These stocks boomed, but you can't really like if you buy just that stock compared to like the S&P, you'll most definitely like outperform by like a big margin. But since if you just invest in the S&P, then you won't realize those gains at all because it's offset by all the negative, um, well, the losses from everything else.
Yeah, thanks, Sonny. That's a good way to put it. Yeah, basically, if the S&P is very broad, and if you have a specific industry that you want to invest in, that would be it would be better to focus your investments in that industry. Okay, so let's move on to the next concept. Okay, so bear with me here. I know this is going to be a little bit dense, so do stop me. So let's say you decide I want to invest in stocks, and you go to Yahoo Finance, and this is what you're going to pull up if you go to the Apple page. So let's take a look at some of the stuff that's on this page. So one here is market cap. You can see my mouse, market cap. Right now, Apple's market cap is $2.029 trillion. So like I said earlier, when you own a stock, you are owning a piece of the company. So Apple has something like 20 billion. Oh yeah, you guys can follow along there if you want. The price, I screenshotted this earlier today, so the price is no longer accurate because it keeps changing, but it's close enough. So Apple stock, so Apple has about, it's like 19 billion or 20 billion shares of stock. So like I said earlier, if you own one share of Apple, you own 120 billion of the company. So let's say you wanted to buy the whole company. That means you would need to buy all 20 billion shares. So the market cap is basically the whole value of the entire company. So it's saying that, okay, if you have $100 a share, or the company is priced at $100 a share, and there's 20 billion shares, that means the company is worth $2 trillion. So Apple has, it's actually like $120 a share, and it's something like 19 billion shares, not 20 billion shares. So it comes out to about $2 trillion. So the market cap is basically the entire value of the whole company. That's the amount of money that it would take for you to buy the entire company. So if you have $2 trillion sitting around, you could buy the entire company of Apple if you wanted to do so. That's the idea behind market cap. Let's so remember, when you own a share of the stock, you own a piece of the company. This metric here, EPS, this stands for earnings per share. TTM means trailing 12 months, so the past year. So it's the earnings per share over the past year. That's what it means. And this value here is 3.69. So what does this mean? So Apple's profit last year was approximately $75 billion. That's the amount of money they earned. Like I said, they have about 20 billion shares outstanding. So if you divide this $75 billion profit that they had by 20 billion shares, that means that each share is entitled to approximately $3.70 of this $75 billion profit, right? Because when you own a share of the company, you're a piece of the company. So if you own 1/20 billionth of the company, you are entitled to 1/20 billionth of its profits. So basically, that's what the EPS, the earnings per share, is saying, is that for each individual single share, it's entitled to or equivalent to, or however you want to see it, $3.70 of its profit. Okay, so that's the EPS. So that's the 3.69 value. That's approximately 3.7 that I have. Now, this, I would argue, is the most important metric for valuing a company, is the PE ratio. And this is not just me saying this. This is generally accepted that this is the most important metric or most important ratio for valuing a stock, is the PE ratio. So Apple's PE is currently at 32.8. So what this means is that we know that the earnings per share is $3.70, right? So each share you own, you're entitled to $3.70 of this $75 billion profit. So the share price of $120 means that if you're willing to buy Apple stock at $120, that means you are willing to pay $120 for $3.70 of profit. So if you divide it out, 120 divided by 3.7, you get approximately 32. So that means you're willing to pay $32 for each dollar of profit that Apple makes. So in other words, it's how much investors are willing to pay for $1 of earnings. Now, the PE ratio will differ based on its company, right? Because if a company has a lot of potential, right? Take a company like Tesla. A lot of people think that Tesla has a lot of potential in the future. So Tesla actually doesn't make a whole lot of money right now. Tesla, up until I think last year, they were actually losing money. But people still invest in the company because they believe in the company long term. So for a growth company like Tesla, the PE is very high. I think right now it's something like $450 or $500. So for every dollar of earnings that Tesla makes, investors are willing to pay $500 for that $1 of earnings. For Apple, it's $32. For other companies that don't grow, say, I keep picking on General Electric, but let's say General Electric. I think it's it's single digits. I think it's something like, I don't even remember, but I think it's like 6 or 7. It's very low compared to 32 or 400 something. Oh, okay. Well, Tesla, okay, it's 1,020. I did not realize that. So Tesla stock actually has increased something like 500 or 600% last year. So I for one did not see that coming, so I did not invest in Tesla, so I lost out on that. But anyway, Tesla's P is 1,020. So keep that in mind. That's what people are willing to pay. So it's actually important when you compare PEs that you may want to compare PEs of similar companies. So for example, you may look at Pfizer and you may look at Merck and you may say, oh, one PE is lower than the other. And if you think that the two companies are roughly equivalent, if you think the two companies have the same growth or same whatever, then you could argue that the one that has a lower PE is undervalued. But it's important when you're comparing PEs to look at companies of the same industry or similar companies, because otherwise the PEs can vary very widely. Okay, so let's take a look at, so when a company makes profit, when a company makes money, oh, we are actually running a little bit low on time. But okay, let me just I'll just get through this. So when a company makes profit, they can either reinvest it in the company. So if a company like Apple, when they make the $75 billion, what do they do with it? They can either invest it in product development, research and development. They can build new factories. They can hold it in cash. They can do whatever they want with it, or they can distribute the money to shareholders in the form of dividends. So remember, when you own a piece of a stock, right, you own a piece of the company. So you're entitled to a piece of those profits. Now, if the profits are being reinvested in the company, theoretically, that increases the value of the company. So you own a more valuable piece of the company. But if a company doesn't know what to do with it, or they don't want to do anything with it, or sometimes investors want dividends because they want the cash payment, they want the immediate profit from the company. So they can be distributed to investors as dividends. I personally really like dividends because dividends mean that you're getting you're basically getting money deposited into your stock account 4 times a year. Every quarter they issue dividends, you get money in your account, and I personally really like having money just randomly being deposited in my account. So I like dividends. And oh, we have a question. Forgot about that. Okay, so why it's okay, so out of order question, follow-up from CS compounding question. It's only compounding when your gains are reinvested versus if a gain is a dividend. No, it's not. So let me see how to explain this. The idea behind compounding interest is time. It doesn't have anything really to do with the means of reinvestment or things of that nature. The basic idea behind compounding interest and the time value of money is that you make money on your money. Now, the way I answered Lucia's question earlier was that if the stock price goes up a certain percentage and then it goes up a certain percentage again, your base is higher so that your earnings for the second year or third year or whatever consecutive year is higher. The same concept works with a dividend. So let's say you have a company that actually AT&T is a good example because AT&T's share price more or less doesn't really move. I mean, it goes up and down, but it doesn't really grow because the reason is AT&T pays out something like 7 or 8% in dividends every year. So basically all the money they earn, they pay out in dividends. So they don't really reinvest the money in the company. They earn money, they pay it out to shareholders. The same concept applies if you take the dividend money you receive and then you buy more AT&T shares with it. It's kind of the same idea. So AT&T, let's say you own $10,000 of AT&T stock. After 1 year, they would have paid you $800 in dividends. You could have taken this $800 in dividends and bought more AT&T stock. So now you own $10,800 of AT&T stock. And then the next year, you would have received even more dividends. You would have received 8% of $10,800. So the compounding interest, the time value of money concept applies based on time, not on the way that the money is being distributed to you. Does that make sense, Sarah? If you have a follow-up question, yeah, you can always put it in the chat. Back to dividends. So yeah, so there's companies that are considered dividend kings. So dividend kings are companies that have had 50 or more years of consecutive increases of their dividends. It doesn't mean a dividend is guaranteed because nothing is ever guaranteed, but it means that chances are the company will continue to pay the dividends. So some examples of dividend kings are Johnson & Johnson, Coca-Cola, 3M. These companies have increased their dividends for the past 50 years. So chances are you will continue to receive this dividend from the company. The company holds these dividends. It's very important that the company continues to pay the dividend because that's what people invest in companies for. So these are stable dividends, basically. Okay, so like I said earlier, there's value stocks, growth stocks. People invest in growth stocks mainly for price appreciation. So most technology stocks are growth stocks. Tesla is a great example of growth stock. Growth stocks often pay very low dividends. Often they actually pay no dividends because they take all the money they earn and they reinvest in the company to grow it more. They have more price appreciation, they're more volatile. Value stocks are generally more established companies. They have higher dividends. They don't increase in value as much, generally speaking. They're more stable. It's basically the difference between growth and value stocks. The line between growth and value is actually very blurred. Officially, Apple is considered a value stock. I would make the argument it should be a growth stock, but I mean, the line is very blurred there. So a couple of things you're going to hear about when you actually like read more about this investing and read more investing stuff online. Number one is that timing the market is very, very difficult. And it's true because market's not always rational. The market goes up, the market goes down. How do you decide when to buy? Everybody knows, oh, you should buy low and sell high. What is considered low? When is low? If something is low now, how do you know if it's going to go lower? It's very, very difficult. I like the idea of buying some, holding some, selling some. So for example, you buy $10,000 of stock at $100, price rises to 150 or 140 or 160, whatever the price rises to. You made some money, sell some of it, keep some of it because the price could go up more, right? The price could go down, but generally, I like that idea. Buy some, hold some, sell some. Another way that I know a lot of people do is they just wait until they have an undervalued opportunity. So if there's a market as a correction, the stock price goes down all of a sudden a lot, then investors will jump into it and all of a sudden just buy a lot of one stock. That's also a good way to do it. If you can wait until you see a great opportunity and then buy that opportunity and then just hold it. That's one way to do it. If you don't want to continually watch the market, continually watch the stocks, you just want to invest. Because in the long term, generally stocks do go up, generally. And so there's a concept called dollar cost averaging, which in full transparency, I don't do, but is a very, very good way to invest. Is that you buy $100 or $1,000 of stock every month, regardless of price. So if let's say you want to buy Apple stock, and let's say you want to buy $1,000 every month. If the price is $100, you buy 10 shares. If the price is $90, you buy 11 shares. Right? The price goes up all of a sudden to $200, you still buy, you just buy 5 shares. So this way, the average cost of your shares will be somewhat pressed down, because when the market is low, you're buying more. When the market is high, you're buying less, but you're still buying. That way, you don't have to worry about timing the market, and you're still getting into the market. Generally speaking, it is a very good way to get in the market. One last point, diversification is very, very important. You don't want to put all your eggs in one basket. Apple is a great company. I believe it's a great company, but we don't know what the next iPhone they're going to come out with is. What if the next iPhone they come out with has some crazy exploding battery that blows up people's houses? You don't want to own an entire portfolio of Apple stock in that situation. So diversifying helps lower the risk that any one particular company is going to have some scandal, is going to go bust, is going to go bankrupt. It's the easiest way to diversify, like I said earlier, to buy low-fee index funds, or just buy a whole bunch of different companies across whole different sectors. One more point is that this is not something we have to worry about at our age, but as you get older, you don't want to hold too much money in stock. The reason being that stock market can be very volatile. For example, last year, within the matter of a week, the stock market went down like 25%, right? You don't want to be 65 years old and about to retire and have your entire stock portfolio go down by 20 or 25%. That's very devastating if that was, if you were in that scenario. So generally speaking, you should hold a certain percentage of bonds. The percentage of bonds you should hold should be equivalent to your age. So if you're 50 years old, you should hold 50% bonds, 50% stocks. If you're 70, you should hold 70% bonds, 30% stocks. Like I said, this is something you can worry about when you're older. I personally don't hold anything in bonds. Don't worry about this now. I will pass this back to Sonny now because I've talked enough.
Thanks. Yeah, on the topic of Apple being like a growth stock, I totally agree because I actually do invest a lot in Apple, and I'm very excited for their iCar, also going to the wearables industry, which is pretty dope. But anyways, let's go back to things you should consider. So since you're making money, Uncle Sam definitely wants to tax you. And this also started, so crypto actually started getting taxed for any sales starting in 2020. Anyways, so the average student would probably fit somewhere within the yellow bracket that we have over here, assuming you're doing part-time or co-op. If you make more or less, I also included the other income brackets for your reference. Something to note is the difference between taxes on short-term and long-term holds. This is something Tou mentioned a little bit earlier. So a hold is considered long-term 1 year after its purchase. And you can see in the yellow bracket again, there is a 12% tax difference between short-term and long-term, and that's quite a lot. So let's say you make 20K, right? You're gonna lose $2,400 if you sold it 364 days after purchase. But if you waited 1 extra day to sell it, you'd actually pay 0. So keep that in mind. So sometimes you also lose money on your investments. That's normal. Sometimes you have like a bad year, pandemic, whatnot. You won't get taxed for that. It's actually considered loss as it's capital loss, and this is actually something that's tax deductible. When you're using these trading platforms, the company will send you all the tax information you need for your taxes, so don't worry too much about it. It's pretty like self-explanatory. I did my taxes like last year. Press like a few numbers and indicate you're invested in stocks. If you're looking for a way to make money with the least complexity in terms of taxes and constant worrying, definitely go long term. I used to be more of a short term like trader, and I was constantly like anxious, always looking at my phone. Anyways, if you can go to the next one. Thank you. So when investing, you always hear the market always goes up, but is this really true? It really depends. If you look at Japan's Nikkei index, which tracks their top 222 companies, they have not changed much within the past 2 decades. And that's caused by a bunch of inflation and high interest rates like 20 years ago. They're still recovering from that. And you can see they kind of like, they're basically where they started off like 20 years ago. And it's kind of crazy. Luckily, in the US, that's not the case. And here is a graph of the S&P 500 index. As mentioned before, it has grown 2,800% in the last 2 decades. For this past year alone, it's grown 17.88%. This is definitely much higher than the 8% we mentioned previously. Imagine making like 18% of your investment in 1 year. That's like free money. That's pretty wild to me. However, this seem too good to be true. You must realize that not every company's stock will perform this way. Consider General Electric's stock performance. They are part of the S&P 500, but you can see their stock does not follow the same pattern as the S&P 500 index. So you can see like on average, right? So the index is basically like the average of like the market. The market is doing way better, and General Electric is just very, very underperforming. It's very sad. So yeah, you must do a lot of research to find the right stock for you. Get to the next one. Thank you. So other things you should consider is the effect of news, media, and politics. A memorable moment from my personal investing career was 2018 when I lost like 20% of my money in 1 week. Why is that? So earlier in the year, Trump imposed a bunch of tariffs on steel and aluminum from China. At this time, my entire portfolio was composed of tech and manufacturing companies such as Apple, Intel, NVIDIA. So why does this relate? So let's look at Apple. I keep talking about Apple here. So most Apple materials are sourced from China. So a tariff on the goods means that Apple will be spending extra money to buy these materials to make an iPhone. And because of this results in less profit per iPhone for Apple. And investors see this as a sign that Apple won't be as profitable as before. So investors sell their positions, sell their holdings, and solidify the profits. When a bunch of people do the same thing and sell, the supply of Apple stock increases, demand decreases, and this results in the plunge of Apple stock value. Let's see.
So Sarah has a question. So Sarah asked, if your stocks get taxed at 15%, will you only make money if your return is over 15%? Okay, so this is the way the math works, right? Let's say I have $10,000 and I buy whatever I buy. It doesn't matter what I buy. Okay. And then let's say I earn 50% returns. I earn $5,000 returns. Okay. I have to pay tax on the profit. So I make $5,000. I pay 15% of the $5,000. So in this case would be $750, right? So I'm left with $14,250. Now, let's say I invest $10,000, and let's say I didn't make a lot of money. Let's say I only made $1. Okay, so I'm left with, at the end of the year, my portfolio is $10,001. I only have to pay taxes on that $1. So I have to pay 15 cents in taxes. So I'm left with actually $10,000.85. Does that math kind of make sense?
Yeah, it's only tax on the profit, not your principal.
All right, so you can go on.
All right. Yeah. So so basically tariffs, right? You can see on the graph a little bit on the left, you see like a big dip. That's when the tariffs were imposed, and I was riding along that, unfortunately. And then a little bit more way on the right, you can see a big spike up. That's when the tariffs were lifted. So you can see the effects of politics in the market. And tariffs made a lot of small companies struggle, such as Boosted, the creator of Boosted boards. So the effects of the tariffs lasted years until they ran out of business in 2020, and that's quite sad for me, but I digress. As you can see, it's important to keep up to date with politics so you can act fast in scenarios like these. Like if you look on the left with that, before that nosedive, if you sold off, knowing early about these tariffs, you could have saved your money and reinvested another time. This may look scary, but it actually might pose a perfect opportunity. If you buy shares when prices go down, as Tou said, this is buying the dip. If you believe that a company is worth more than the current price or think the decrease in price is unreasonable, you can buy the share at a discount and expect the stock to bounce back to its previous value. That's what I personally do. Next slide.
So Sarah has a follow-up question.
Oh, yeah.
I don't have a follow-up question anymore.
Oh, okay. Well, I do want to point something out. Let's say the same scenario. Like I buy $10,000 of this investment, and the value of the investment goes up. Okay, so the value of the investment goes from 10 to 15, and I don't sell it. As long as I don't sell it, I don't owe any taxes on it. So if I held it for a year and I said, I'm just going to keep it for now, I don't owe any taxes on it. I don't have to pay any sort of taxes on it yet. I don't pay taxes on it until I sell. Okay, so let's say that I keep it for another year, and the value of my initial 10,000 investment goes up to 20,000. Okay, and I decide, okay, I'm going to sell half of it. When I sell half of it, that means I sold 10,000. The cost basis of that 10,000 is 5,000, right? Because we started with 10, we got to 20. And so if I'm only selling half, I'm selling 10, that means that the 10 initially cost me 5. So my realized gains are only $5,000. The other $5,000 are unrealized. So the other $5,000 I don't pay taxes on until I sell it. So if you only sell a portion of it, you only pay taxes on the portion that you sell. We actually didn't get into that, which is probably an important thing. But okay, Sonny, I'll.
Oh, it's fine. Can you go to the next slide? Yep. So other examples of the effect of media, politics, and whatnot. One would be the pandemic, obviously. So by March 2020, the entire market was down 30%, as you can see. This was due to investors fearing profit loss from companies driven by a large reduction in consumer spending. People are now more careful with their spending, won't be going to restaurants or traveling. You'll see food, aviation, tourist industries plummet because of COVID. However, on the flip side, companies like Zoom, Tupperware, Peloton, Lululemon, they were all flourishing due to the stay-at-home environment. People were Zooming, cooking, exercising, and rocking at leisure. So I don't have the numbers up here, but respectively, so Zoom went up 400%, Tupperware went up 3,000%, Peloton 600, and Lululemon 200. So if you were paying attention to these companies during the pandemic, you definitely could have taken this as a money-making opportunity. And then on the top right, you can see Tesla stock. This was in 2018, I think. This is Elon Musk famous 420 tweet. And you can see like right immediately after he tweeted, the stock price went up 10%. This like Tesla didn't suddenly just become 10% more like valuable, but the tweet did make investors more confident in the company, so people bought more stock. And he has similar influence over recent gains in Bitcoin and Dogecoin as well. And our last example on the bottom right, I'm not going to talk too much about it. You probably heard about it throughout the past month, but this is GameStop, and it's very, very crazy rise. And you can read about it, but nevertheless, stocks go up and down for random, unexpected reasons, or like you can't really predict it. So the more you know, the better you're better off. Next slide. So as I say, it's very important to keep up to date with the news for the companies you invest in. I highly recommend listening to the Robinhood Snacks Daily, which is an entertaining breakdown of the top 3 business stories in 15 minutes. If that's too long for you, they have Snacks Minute 2, which is, it covers the same topics in 3 minutes. It's a great way to get a feel of what's going on in the market and changes in consumer trends and the politics that may affect companies. And I am pasting it here if you want to look into that. Next one, it's the last one. So now that you have all this information, you can finally start investing. To invest, you'll need a trading platform offered by a brokerage firm. Common ones are Robinhood, Charles Schwab, Webull, and Fidelity. I personally use Robinhood for stocks and crypto, and Charles Schwab for Roth IRA. Tou, what do you use again?
I use Fidelity. I used to use Robinhood. Now I pretty much strictly use Fidelity.
Yeah. So there's like a bunch of different platforms you can use. Definitely pros and cons. You can look those up later. Yeah. And you can download these apps, create an account to start. You'll deposit some money in your bank account and you'll be able to start buying. If you want to use Robinhood, here, I will little plug. Here's an invite link. So if you do plan on starting investing, you can sign up on Robinhood and you'll get a free stock for signing up. And the stock will value upwards to $500. Let's see. So also a fun fact about Robinhood, most brokers used to charge you money to make trades. So how much did you have to pay when you made trades on Fidelity?
Yeah, when I started investing, it would have been about 3 years ago. Fidelity and all the brokerage firms, basically, besides Robinhood, were charging $4.95 a trade, so almost $5 each time you made a trade. It's quite expensive. And Robinhood was kind of the pioneer in that they were letting people trade for free. And so Fidelity and all the other brokerages basically followed suit about 2 years ago. So they canceled the $5 fee. So it's actually, this is the no fee trading is really a new phenomenon.
Yeah, so Robinhood basically introduced it. All the other brokers were like, wow, we're losing customers to y'all, so we're also gonna offer zero trade fees. So that's really good on us consumers. Something else too, I know Charles Schwab also has this, but I think Robinhood started off first with fractional shares, which means you can buy a fraction of a share. So for example, Amazon stock, 1 share right now, it's around like $3,000. Before fractional shares, you needed at least $3,000 to buy that 1 share of Amazon. However, now you can buy any percentage of Amazon stock. You can invest like $10 or $1 or like a few cents if you really wanted. And that money would grow to the same behavior as the actual Amazon stock. And then finally, how much should I invest in? As we all said, however much you're willing to invest. I personally put all my co-op money into it because what is it going to do to my checking account? Like lose value? So however, if you're new and you want to be cautious, I think maybe like $200 to like $1,000 would be a good starting point. I personally started off with like $200, and you can use that money to play around, see how the market works, how to sell, when to sell, things like that. The worst case, say you lose like all your money. Worst case, you lose all your money. It's like you lost like $200 compared to like if you were to put up all your money, go all in, and then lose all your money, that would hurt way more, But you're not going to lose all your money. That's like pretty rare. But yeah, so once you have a better understanding of the market, you can invest as much or however you like. So this concludes the presentation. Thank you for joining us, and we hope you got something out of this, especially the compound compound interest. So,
I actually do want to end with a few comments.
Yeah, go ahead.
So these comments are strictly my opinion, but I think one of the largest fallacies of financial modeling is the expectation that past performance will continue to the future. Throughout this presentation, we use 10% return as an example. 10% is an easy number. I think 10% is very optimistic. Okay, I don't think that any of you should be expecting consistent 10% returns. There are a lot of reasons as to why I don't think it's necessarily accurate to expect 10% returns over the next 50 or so years. But here's the thing. The market does this, right? It goes up, and then it crashes, and then it goes up, and then it crashes again. So it does this. So if you cherry pick the year like that's at the bottom, and then you pick this year and it goes up to here, then obviously the returns are higher than if you pick the peak year the year before and do that, right? So if you look at the long run, the S&P 500 does go up about, I like to use as a real, like a true average, about 7%. 7% is really what it really goes up. But if you take this into consideration that it goes up 7%, you need to pay taxes on your money that you earn, right? So if your tax rate is like 25 or 30%, okay, that 7% becomes 5% because you had to pay a third of it in taxes, okay? And don't forget that what Sonny talked about before was inflation, right? So if the value of your dollar loses value every year. So if inflation is, 2 or even let's say 3%, because historically it's been 2 or 3%, right? So if you're making 7% in the S&P 500 and you pay a third of it to taxes, you're left with 5% returns. And if the inflation is 3%, your real rate of return is really only 2%. So it sounds like, oh, you're going to make a ton of money. In reality, you're probably not going to make a ton of money. And that's why it's important to consistently invest, because if you don't invest, you're almost guaranteed to lose money. So, and another thing is that, the market is very unpredictable. Like I said, the numbers we use are very optimistic. And it sounds great. You're going to make 10%. You're probably not going to make 10%. In reality, the real amount of money you're going to make is something like 3. Okay. And so, if you solely invest in S&P 500, now a lot of people will choose individual stocks in addition to their S&P 500, and they will make higher returns. Another thing, you will lose money. Anyone who invests will lose money. I've lost money. Sonny's lost money. We've all lost money. Not all investments are good investments. It doesn't mean you should be afraid to invest. It does mean you should be careful. Don't throw money in companies blindly. Buying and hoping is not a strategy. You can't necessarily control how the market's going to move. You're never going to be able to pick the best investments, but it's very complicated. But in my opinion, the key is just to control what you can, and what you can control is save your money, invest your money, invest early, invest often, maintain a diversified portfolio. So.